What just happened in the silver market over the past week is something that hasn't occurred in over 40 years. And I'm not exaggerating. The numbers are so extreme, the volatility so violent, that even veteran traders who have been in this business for decades are saying they've never seen anything like it. I'm Mr. AG, and today we need to have a serious conversation about what January 2026 meant for precious metals, why silver just snapped back to $90 after crashing to 71, and whether the chaos we witnessed was the end of something or the beginning of something much, much bigger. Because here's what I think most people are missing. Everyone is focused on the crash. Everyone is focused on the 30% single-day decline. Everyone is focused on the fear, but almost nobody is talking about what comes after the crash. And what comes after might be the most important part of this entire story. Let me walk you through exactly what happened, because the sequence matters more than any individual day's price action. January 2026 was one of the most extraordinary months in the history of precious metals markets. Gold climbed to a record high of $5,595 per ounce. That's up 29.5% in a single month. Think about that. Gold, the asset that's supposed to be boring, that's supposed to move slowly, that's supposed to be the stable anchor in your portfolio, gained nearly 30% in 30 days. But gold was the calm one. Silver absolutely exploded. It surged through the psychologically important $80 level, then through 90, then through 100. It kept going and going until it briefly traded at a record high of $121.65 per ounce. That's up 70% in a single month, 70% in 1 month for silver. People who had been waiting years for silver to hit $50 watched it blow past 50, past 60, past 80, past 100, and keep going. The moves were so fast, so violent, that traders couldn't keep up. Charts looked broken. Technical indicators were screaming overbought at levels they'd never registered before. And then, in the final days of January, everything reversed. Sentiment shifted. Fear replaced greed. And the market experienced what can only be described as a historic meltdown. Silver fell by roughly 30% in its worst single session since at least 1980. Let that sink in. The worst day in 45 years? Gold dropped around 12%. Platinum and palladium got hammered too. The reversal was so violent, so sudden, that exchanges around the world responded by raising margin requirements and warning traders that the market was dangerously overbought. The CME group lifted margins across several precious metal contracts, forcing leveraged traders to either post more cash or liquidate their positions. And when leveraged traders are forced to liquidate, they don't sell at prices they want. They sell at prices they can get. And that selling creates more selling. Margin calls cascade through the system like dominoes falling. This is what happened. This is why prices moved so far, so fast in both directions. It wasn't just about fundamentals. It was about market structure, leverage, and the brutal reality of what happens when everyone tries to exit through the same door at the same time. Now here's where the story gets interesting. Because after all of that chaos, after the historic crash, after the panic and the liquidations and the fear, silver just bounced back nearly 6% in a single session to trade around $90 an ounce. Gold climbed 2% to hold above $5,000. The metals didn't stay down, they bounced hard. Joshua Chim, general manager at online broker FS Moan, summarized the current situation perfectly. He said they expect elevated volatility to continue in the near term, but stabilization should return once the market finds its footing. That phrase, once the market finds its footing, is crucial. Because right now, the market hasn't found its footing yet. We're in a transition period between the explosive rally, the violent crash, and whatever comes next. And the question everyone is asking is simple. What comes next? Let me give you some frameworks for thinking about this, because I think there are several forces at play that most people aren't considering. First, you need to understand why this rally happened in the first place. It wasn't random. It wasn't just speculation. There were real forces driving prices higher, and those forces haven't disappeared. The surge to all-time highs was driven by a mix of factors. Safe haven demand was significant. Geopolitical risk from the continuing conflict between Russia and Ukraine contributed. Uncertainty around U.S. intentions in Venezuela, Greenland, and Cuba added to the anxiety. Central bank buying continued at a strong pace. There were large purchases by blockchain newcomer Tether. Expectations that the U.S. dollar would remain weak played a role. Potential expansion of the U.S. tariff regime created uncertainty. And several high-profile Supreme Court cases challenging decisions made by the U.S. administration added to the overall sense of instability. These aren't temporary factors. These are structural forces that will persist regardless of short-term price movements. For silver specifically, the rally was driven by additional dynamics. There was a genuine short squeeze as traders who were betting against silver got caught on the wrong side. Industrial users were buying intensely, securing supply in an uncertain market, and there was massive retail speculation, particularly from Asia. Ole Hansen, the commodity strategist at Saxo Bank, described it bluntly. He said there's been a massive retail frenzy getting into these markets. And he said the search for a floor hinges on China demand and calmer trading. That phrase, a massive retail frenzy, tells you something important about what happened. This wasn't just institutional money flowing in and out. This was millions of individual traders around the world, particularly in China, piling into silver with leverage at exactly the wrong time. When those traders got caught in the crash, they were forced to sell, and their selling pushed prices even lower. It's the classic cycle of leverage-driven markets. The leverage amplifies the gains on the way up and amplifies the losses on the way down. Now here's where I want to introduce a perspective that might make some of you uncomfortable. Rona O'Connell, an analyst at StoneX, made a statement that I think deserves serious consideration. She said, and I'm quoting directly, "There's not much I can add to my warnings about how silver is always a death trap. Always a death trap." Those are strong words from a serious analyst. And I think you need to hear them, even if they're not what you want to hear. Silver has a personality that differs from gold. Gold moves with dignity. Gold is the asset that central banks hold. Gold is what serious institutions allocate to when they want stability. Silver is different. Silver moves with violence. Silver overshoots in both directions. Silver creates fortunes for some people and destroys others. Silver is the metal that can go up 70% in a month and then crash 30% in a day. If you're going to participate in the silver market, you need to understand this personality. You need to accept it, and you need to size your positions accordingly. The people who got destroyed in the recent crash weren't the ones holding modest positions they could afford to sit on. They were the ones who were leveraged to the hilt, betting everything on prices going higher forever. When the turn came, they had no room to survive. That's the death trap O'Connell is warning about. Not that silver can't go higher. It absolutely can. But that silver's volatility will shake out anyone who does not have the positioning and the psychology to survive the swings. Now, let me give you some context on where prices might be headed because there are competing views on this. Some analysts have argued that a more fundamentally supported silver price sits in the $60 to $70 range. They point to technical support near $66 using Fibonacci levels, which is a common chart-based method for gauging support and resistance. If they're right, silver's current price, around $90, is still significantly above fair value. That would suggest more downside is possible, maybe even likely, before a sustainable floor is established. But here's the thing about fundamental analysis in a market that's experiencing a paradigm shift. The old models might not apply anymore. And that brings me to the Supercycle thesis. Marex, a major commodities broker, published an analysis that I think deserves serious attention. They acknowledged the chaos. They acknowledged the sharp corrections. But they concluded with something provocative. They said, and I'm paraphrasing here, that we believe the market has undergone a paradigm shift and that we are entering a new supercycle. A paradigm shift, a new supercycle. Those are big claims. Let me explain what they mean. A supercycle is a prolonged period, often lasting a decade or more, during which commodity prices trend higher due to structural changes in supply and demand. The last supercycle ran from roughly the early 2000s until around 2011, driven primarily by China's industrialization and infrastructure build-out. The argument for a new supercycle rests on several pillars. Pillar 1 is re-globalization and the remaking of global supply chains. Countries and companies are restructuring their supply chains to ensure security of supply. This is causing bottlenecks where inventory is locked up in certain locations, creating shortages elsewhere. Silver and copper are the most obvious examples of this phenomenon. Think about what's happening with critical minerals and strategic commodities. Countries are stockpiling, companies are securing long-term contracts. The just-in-time supply chain model that dominated for decades is being replaced by just-in-case stockpiling. That structural shift creates demand that didn't exist before. Pillar 2 is the AI and renewables demand cycle. The rapid growth of solar power has been an important factor, particularly for silver. Every solar panel requires silver. Every data center supporting AI requires massive amounts of copper and other metals. As these technologies scale, so does metal demand. This is probably more about psychology right now with respect to AI, but the growth in solar power is real and measurable. And that growth translates directly into silver demand that won't go away just because prices pulled back. Pillar 3 is what they call de-fiatization. This is about more than just dollar weakness. It's about the same concerns being leveled at every major currency other than perhaps the Swiss franc. Aging populations, excess debt, ongoing fiscal deficits. These problems aren't unique to the United States. They're global. In that environment, the argument goes, owning hard assets makes structural sense. Gold and silver aren't just hedges against the dollar. They're hedges against the entire fiat currency system. If these structural drivers are real, and I think there's a strong case that they are, then the recent crash wasn't the end of the metals rally. It was a violent correction within a larger uptrend, a shakeout, a reset, a chance for the market to clear out the excess speculation before resuming its climb. That's the bull case, and it's a compelling one. But I want to be honest with you about the risks because I think you deserve a balanced perspective. The near-term picture is genuinely uncertain. Merricks themselves acknowledge that over the coming weeks they expect heightened volatility with sharp price swings testing bullish conviction. Sharp price swings testing bullish conviction. That's a polite way of saying there will be more scary days ahead, more declines that make you question your thesis, more moments when selling feels like the right thing to do. And here's the reality about the physical market right now. Downstream physical markets have weakened. The copper curve has shifted from significant backwardation, which signals tight supply, to a wide contango, indicating looser conditions and rising inventories. In plain English, the immediate physical demand picture has softened. China's manufacturing sector is in its Lunar New Year holiday period, which means activity is reduced. Normal buying patterns won't resume until late February or possibly March. So you have a market where the long-term structural case is bullish, but the short-term physical fundamentals are weak. That creates the conditions for exactly the kind of volatility we've been seeing. Rallies that feel convincing, followed by sell-offs that feel devastating. Now let me talk about what catalysts are coming because traders are watching several events very closely. On February 5th, the European Central Bank's Governing Council wraps up its monetary policy meeting, followed by a press conference. The same day, the Bank of England publishes its policy summary in minutes. These central bank decisions matter for precious metals because they affect interest rate expectations, currency movements, and safe haven demand. If the ECB or BOE signals more dovish policy, that could support metals. If they're more hawkish than expected, it could create headwinds. In the United States, the data picture is unusually murky right now. The Labor Department's monthly employment report for January was pulled from Friday's schedule during the brief federal shutdown, and officials have not set a new publication date. A weaker than expected ADP report showed U.S. private payrolls rose by only 22,000 in January, which is a very soft number, but markets barely reacted because economists often treat the ADP series as a noisy guide to government data. The bigger issue for rates traders is when the official jobs report reappears and whether gaps in data flow keep volatility in currencies, yields, and metals elevated. In other words, we're flying a bit blind right now. The normal data flow that helps traders calibrate their expectations is disrupted. And when information is scarce, volatility tends to increase. For silver specifically, the next tests are straightforward. Can it hold above $90 without another round of margin-driven selling? And do central bank decisions and delayed U.S. data keep safe haven flows in play? These are the questions that will determine whether the rebound continues or whether we see another leg down. Now let me talk about something that I think reveals an underappreciated aspect of this story: the impact on businesses that use silver as a raw material. Shares of Danish jeweler Pandora jumped as much as 10% on Monday as silver prices crashed. The reason was simple. Lower silver prices mean lower raw material costs for a company that uses silver in its products. Analyst Janne Vincent Kjær at Jyske Bank cited the spike in silver prices as a key market worry for Pandora in recent months. When silver was racing toward $120, Pandora's cost structure was under severe pressure. Now that silver has pulled back, that pressure has eased. This is a reminder that volatile commodity markets create winners and losers on both sides. Silver investors might be celebrating the rebound to $90, but industrial users and manufacturers are probably relieved that prices are lower than they were a week ago. This dynamic matters for understanding where price support might come from. If silver falls too far, industrial buyers step in to secure supply at attractive prices. If silver rises too fast, those same buyers pull back, waiting for better levels. It's a natural balancing mechanism that tends to moderate extreme moves over time. Now let me address the volatility directly, because the numbers here are absolutely staggering. 10-day realized volatility in silver hit 186% on Friday, according to Pepperstone strategist Chris Weston. Let me put that in context for you. Realized volatility is a backward-looking measure of how big the day-to-day price moves have been. A 186% reading means the daily moves have been extraordinarily large by historical standards. For comparison, typical realized volatility in silver might be in the 20 to 40% range during normal market conditions. Even during volatile periods, it might spike to 60 or 80%. 186% is off the charts. It's the kind of reading you see during genuine market crises. It's telling you that liquidity can vanish quickly when positions are leveraged, and that the normal rules of orderly trading have broken down. This volatility is both the risk and the opportunity. It's the risk because positions can move against you dramatically in very short time frames. A 5% position can become a 10% loss overnight. Leverage can wipe you out entirely. But it's also the opportunity because volatility creates mispricings. When fear peaks, assets can trade below fair value. When greed peaks, they can trade above fair value. Skilled traders and patient investors can exploit these mispricings, but only if they have the capital and the psychology to survive the swings. Now, let me give you my honest assessment of where we are and what might come next. I think the evidence strongly suggests that the metals market has undergone a structural shift. The factors driving demand, from geopolitical uncertainty to central bank buying to industrial applications to currency debasement concerns, are not temporary. They're not going away because prices pulled back. At the same time, the short-term picture is genuinely uncertain. The Chinese retail frenzy that helped push prices to record highs has cooled. Margin requirements have been raised, reducing leverage in the system. Physical demand for manufacturing has softened seasonally. This creates the conditions for continued volatility. Rallies that feel convincing, followed by pullbacks that feel scary. Each swing will test conviction. Each swing will shake out some participants and draw in others. The people who will do best in this environment are not the ones trying to trade every swing. They're the ones who have a clear thesis about where the market is headed over the medium to long term, and who size their positions so they can survive the short-term noise. If you believe in the supercycle thesis, if you believe the structural factors driving metal demand are real and persistent, then the recent pullback from record highs looks like an opportunity. Prices are lower, the speculative froth has been cleared out, long-term holders can accumulate at better levels. But if you're not sure about the thesis, if you're just chasing price action, if you're using leverage you can't afford, the recent volatility should be a warning. This market will punish overconfidence. It will punish poor positioning. It will punish anyone who doesn't respect its capacity for violent moves in both directions. Let me leave you with some thoughts on how to navigate what comes next. First, understand that volatility is not going away anytime soon. 186% realized volatility doesn't normalize overnight. Expect more wild days. Expect more headlines. Expect more moments when you question everything. Second, size your positions for survival, not for maximum profit. The graveyard of trading is filled with people who were right about the direction, but wrong about the sizing. They couldn't survive the drawdown before the move they predicted actually happened. Third, watch the physical market. Paper prices can detach from physical reality temporarily, but they eventually reconnect. If physical demand from China resumes strongly after Lunar New Year, that's bullish. If physical demand remains weak, that's a warning sign. Fourth, pay attention to central bank decisions. The ECB and BOE meetings on February 5th could move markets. Any signals about the path of interest rates, inflation expectations, or economic outlook will affect precious metals positioning. Fifth, don't let the noise overwhelm the signal. There will be countless headlines, countless predictions, countless people telling you to panic or to buy aggressively. Filter it all through your own thesis, your own risk tolerance, your own time horizon. Now, here's my question for you, and I want you to really think about this. After everything that happened in January, after the record highs and the historic crash and the violent rebound, has your view on precious metals changed? Are you more bullish, more bearish, or more uncertain than you were a month ago? There's no wrong answer. But knowing your own mindset is essential for making good decisions in a volatile market. Let me wrap this up with a broader perspective because I think it helps to zoom out from the day-to-day chaos. January 2026 will be remembered as one of the most extraordinary months in the history of precious metals markets. We saw silver hit levels that seemed impossible. We saw a crash that matched anything from the past 4 decades. We saw volatility that broke normal metrics. But when the dust settles and historians look back at this period, I think they'll see it as a chapter in a larger story. A story about the remaking of global supply chains. A story about the transition to renewable energy. A story about the limits of fiat currency systems built on ever-increasing debt. The paradigm shift that Marex described isn't something that happens in 1 month. It's something that unfolds over years and decades. January 2026 might have been the moment when that shift became undeniable, when the violence of the price moves forced everyone to pay attention. Or it might have been a speculative blow-off top that marked the end of an era. That's the honest uncertainty we're living with right now. What I do know is that the forces driving precious metals higher, the supply constraints, the industrial demand, the currency concerns, the geopolitical uncertainty, none of these have been resolved. They're structural, they're persistent, and they'll continue to influence prices regardless of what happens in any single month. So whether you are a long-term holder building a position over time or a trader trying to navigate the swings, the key is the same. Understand the forces at play, respect the volatility, size your positions appropriately, and don't let short-term noise drive you to make decisions you'll regret. The metals market just went through something unprecedented. What comes next is genuinely uncertain. But that uncertainty is exactly what creates opportunity for those who can navigate it wisely. That's it for today. If you found this breakdown valuable, hit the like button. It helps more than you think. Subscribe if you haven't already. And share this with someone who needs to understand what's happening in the metals market right now. I'm Mr. AG, and I'll see you in the next one. Stay sharp out there. The markets are wild, but the opportunities are real for those who understand what's actually happening beneath the surface. One final thought before I go. The phrase that keeps coming back to me through all of this is testing bullish conviction, because that's exactly what's happening. The market is testing whether bulls really believe in their thesis or whether they're just along for the ride. Every pullback, every scary headline, every 30% crash is a test. Do you still believe? Do you still hold? Are you willing to buy more at lower prices, or does the fear overwhelm you? The people who pass these tests, who maintain conviction through the volatility, who don't let fear drive their decisions, they're the ones who capture the big moves over time. The people who fail the tests, who sell in panic, who abandon their positions at the worst possible moment, they are the ones who watch from the sidelines as prices eventually go where they always thought they would. January 2026 was a test. The rebound to $90 suggests some people passed. The forced liquidations suggest many didn't. The next test is coming. It might be tomorrow, it might be next week, it might be next month. But it's coming. And how you respond will determine your results. So ask yourself, honestly, are you positioned to pass the next test? Do you have the conviction, the capital, and the psychology to hold through whatever comes? If the answer is yes, then the volatility is just noise on the path to wherever prices are ultimately headed. If the answer is no, then you need to adjust something before the next test arrives. Maybe your position size, maybe your time horizon, maybe your understanding of why you're in this market in the first place. Because in a market with 186% volatility, with historic crashes and explosive rebounds, the only sustainable edge is knowing yourself well enough to survive whatever comes. All right, that's really it for today. I appreciate you watching. I appreciate you thinking critically about this stuff. And I'll be back soon with more analysis as this extraordinary period in metals markets continues to unfold. Take care of yourselves out there. The markets are teaching us something right now. Make sure you're paying attention to the lessons.